morning and welcome to the inaugural 10x Quarterly Multi-Asset Outlook webinar. 10x Investments has been managing South Africans prepare for retirement for 16 years, and we manage over 45 billion across a range of unit trusts, ETFs, and bespoke solutions for financial intermediaries. And in addition to our financial intermediaries offering, we also have a well-established corporate employee benefits and umbrella fund offering, and of course, our direct-to-consumer channel. So in essence, any investors can access our expertise, whether you're investing for yourself, advisor or wealth manager, or investing via your corporate pension scheme. We know that it is more challenging to grow wealth in real terms and deliver inflation-beating investment returns to South Africans than ever before. And that's why at 10x we have a robust and proven investment philosophy that does what it says on the tin and ensures that our clients and their clients in turn can meet their financial goals and retire comfortably. So in essence, we focus on providing consistent returns that deliver the target outcome with certainty. And our house view is expressed via our range of large and established multi-asset funds. Our flagship multi-asset fund, the 10x Your Future Fund, returned over 15% last year to investors and has consistently outperformed the peer group since inception. My name is Michelle Knopf. I run the Financial Intermediaries channel, and I'll shortly be handing over to Anton, our CIO, and Chris Eddy, our head of multi-asset funds. Prior to joining 10x in 2021, Anton spent managing investments in the UK. Most of that time was spent at Legal and General Investment Managers as the CIO of their $1.5 trillion business, spanning both active and passive investment strategies across all asset classes. And Chris has been with 10x for a decade and is responsible for the incredible track record of the multi-asset range. Today, we are hosting the first of our quarterly multi-asset outlook webinars. The presentation today is going to last around 40 minutes, but we're going to have plenty of time for taking live questions at the end. And we invite you to use the Q&A tool on your Zoom software to ask any questions as they come to mind during the presentation so that we can discuss them at the end. And there'll be a short survey that pops up on your screen as you leave today's session. We would really appreciate your feedback so that we can keep these sessions relevant and interesting to you going forward. So thank you once again for joining us today. And with that, I'm going to hand over to Anton, Eser, and Chris Eddy.
Great, thanks, Michelle, and hello to all of you on the call. So Chris and I, as Michelle mentioned, we're going to do about 40 minutes of going through a bunch of slides, and then looking forward to a Q&A towards the end. We've structured this in that we're going to spend the first 5 or 10 minutes just talking a little bit about the first quarter. So we'll talk a little bit about the market performance and the big drivers, and then unpack the performance of the future fund. But most of the presentation is going to be very much set around the outlook and portfolio positioning. The way we've structured that is to unpack 3 key themes, 3 key kind of risk factors, which are going to be critical for the rest of 2024, and crucially, how that impacts the portfolio positioning going into the second quarter. So firstly, in terms of the last quarter, so what you have here in front of you is breakdown of portfolio of performance of asset classes across what we define as growth assets, so equity, and defensive assets, so bond and cash. And we'll just kind of pull out a few numbers. This is in rands over a 3-month period, and then over the last 12 months. So I think the key things, which I think most of you obviously will be very aware of, is the continuing underperformance of SA assets. So you can see the SA equity year to date down 2.2 and marginally positive over the last 12 months. And then also SA bonds down 1.8 in the last quarter and 4% or so over the last 12 months. This is relative to what we're seeing in global equities, in particular developed market equities, which has been significantly driven by what's happened in US equities. So developed market equities, another 12% up in the first quarter of 2024. On the back of a very strong performance in 2023. So, I think it's pretty clear from what you see here in terms of where the performance has been coming from over the last 3 months and over the last 12 years. It's been very much a kind of quarter which has repeated what we saw in 2023. So what we are going to do from here is just to unpack a little bit, just very briefly. Chris is just going to talk through those three kind of main differences in performance across equities in the US and SA. Chris.
Yeah, thanks, Anton, and good morning, everyone. Thanks for joining. What we saw over the last 3 months and the last year, really from a global equity perspective, is a continuation of a trend that's been going on for the last 5-10 years, where developed market equities have been the main driving source of returns in portfolios. But over the last 5 years, you've really seen US equities kind of take the lead. So the chart there on the left-hand side, we've split out S&P 500, so representative of US equities in rand terms, and compared that to global equity returns ex-US, and you can see quite a significant divergence there. So whilst global equities have been delivering strong returns, that's primarily been driven by US equity market exposure, and we know that US equities make up about 65% of global equities. So if the US does well, global equities does do well. What's interesting, though, is if you unpack in detail what's been driving that strong US equity market performance, it's been highly concentrated in a handful of shares. You would have become familiar with the Magnificent Seven, so the likes of Amazon, NVIDIA, to name a few, including Microsoft. But really a significant divergence, and that strong performance has been highly concentrated in a handful of shares. So what you've got is a situation where US equity market performance has been significantly concentrated, and US equity exposure in global portfolios has been concentrated. So without exposure to this part of the market, really portfolios would have lagged broader market returns. From a South African perspective, we've seen really a continual uptick in yields, both real yields and nominal yields, and really that's led to the underperformance of bonds relative to cash over the last year. The higher South African yields have been driven both by elevated and increasing core rates, so those like you've seen US Treasury yields have been increasing, but equally you've seen a step change in the risk premium that is being priced into South African bonds. And the chart on the right-hand side shows that effectively through the lens of the difference between the South African 10-year and the US 10-year, you can see that step change in the risk premium over the last couple of years. When we look at South African equities, those high rates and high real rates in South Africa have certainly been a headwind and a challenge for South African equity valuations. But equally, there's been many of the structural challenges in the South African economy that we know all too well at this stage in terms of electricity and logistics. And equally more so, some concerns around certainly some upcoming risks in terms of general elections at the end of May. But what you've seen, if you kind of benchmark South African equity valuations relative to broader emerging market peers, is that there's been a significant derating of South African equities relative to broader emerging markets over the last year. And this has really been the headwind to South African equity market performance as South African equities have derated. So that's kind of a high-level overview of some of the main asset class themes over the last 12 months. Anton, what has this really meant for portfolio performance?
So yeah, here we have the 15-year performance numbers. I'm going to kind of hone in much more on the last 3 months and in particular the last 12 months. As Michelle mentioned earlier, that the performance of the Future Fund has been very strong really since inception, and you can see that performance continued into 2023 and has continued over the last few months. 2.5% outperformance versus peer group and comfortably outperforming the outcome objective. I think just kind of 3 points to talk through here, just so we can finish off kind of what we've done over the last quarter and move on to positioning and outlook is really at the end of 2022, we made a significant shift in the portfolio from SA equities into global equities. That was obviously linked to the increase in the allowance from a Reg 28 perspective, but that's overweight exposure to global equity and a pretty defensive position and lower exposure to SA equity has been a big factor in the last 12 months. And then secondly, the higher allocation to cash, across both SA or cash for the portfolio, and still does today has around 14 to 15% in cash. across global and SA, and with cash yields being so attractive, that's been a very nice contributor to returns and a dampener in terms of risk. And we're going to unpack that when we talk about the themes and talk about how we position the portfolio. The final chart on positioning is just to demonstrate how the process works. We spend a lot of time talking about long-term asset allocation. We're not stock pickers, we're not tactical asset allocators. We very much take a long-term approach to asset allocation, and a big factor in that is valuations, and in particular what we have here, what's the equity risk premium, which is effectively the different valuations between equities and bonds. And you can see here on this chart, the equity risk premium, really, we've kind of dated this almost back a couple of years, has been continuing to decline over this period of time. And that's the kind of the light blue part of the chart, and then the dark blue line. And then the light blue part of the chart is what our total equity exposure over that period of time has been on the back of what's been a declining equity risk premium through this cycle. So really, as equities have rallied and bonds have sold off and cash has become more attractive, so the relative attractiveness of equities is just diminished for a long-term investor like ourselves. So that's kind of gives a little bit of context as to what we've been doing over the last 12 to 15 months, just at a high level across the portfolio. So that's the past. What we're going to do from here is just to use the last 30 minutes really to talk about three key themes. So the way we've structured this, and this is actually what we do with our monthly Global Compass, is focusing on three charts, three themes. And in particular, what we want to do is unpack those themes, and most importantly, link that to how we think about the portfolio positioning, what those key themes mean. Once again, these themes are themes which are relevant for markets over the course of 2024. But importantly for us, it's how it links into the long-term positioning of the portfolio. So often these will be risks, but they also impact how we kind of diversify the portfolio, and we think about positioning across the portfolio. So there's three there. SA elections. Chris is going to start with unpacking that. Obviously, it's super topical. We're then going to talk about US equity valuations and what that means to the portfolio. We've been doing quite a few roadshows around that in the first few months of the year. And then the third one, elephant in the room, really is US fiscal risk. So let's dive into that, Chris.
Great. So yeah, this and you would have certainly seen over the last couple of weeks and months a lot more noise coming through, a lot more information coming through in terms of polling. So what we've pulled up here is really, you can think of it as a consolidation of all the different polls that are currently being run in South Africa, by-election data and other data as well. It's from No Africa research consultants working with Nedbank, and it really provides a high-level overview and temperature check of where current polling has the relevant parties. And kind of the clear message coming out of this is that it's going to be the first time from a national perspective that the ANC falls under 50%, and all data points are really pointing to that. And why that's meaningful is that it introduces coalition politics into South Africa at a national level for the first time post our democracy. Across the board, you're kind of seeing that it looks like the ANC may fall below 45%. Why is that a number important? Well, it means that they would then start to have to move into coalition politics with a more meaningful party. There's talk around IFP. They've certainly thrown their hat in the ring there in terms of being open to those sort of considerations. But I think some of the risks from a market perspective are really if the ANC drops below 40%, because what that will then mean is that they would need to move into coalition with either sort of the DA on the one side or a combination of EFF and MKP, which seems to have come to more prominence over the last couple of months. And that combination and coalition with the EFF/MKP is really a bit of a tail risk from a market perspective. So for us, we're not trying to predict what the outcome of the election is, but understanding the range of different scenarios and how that is reflected in asset pricing is important for us in terms of how we build our portfolio. So this kind of sets the scene, which is really that the ANC support is declining. Where that lands post the elections will be important in terms of setting the range of different scenarios. But what we've seen in terms of how the tail risk of a EFF coalition has been priced into different asset class markets has been different. The chart on the left shows a ratio between the South African CDS versus emerging market CDS, and really it's a reflection of credit risk, so sovereign credit risk. And what you can see is that ratio going back over the last 10 years has been moving from the bottom left to the top right. So ultimately, as we've seen South Africa's fiscal position deteriorate, as we've seen continued load shedding and concerns around South Africa's debt sustainability, that is being priced into South African bonds. What's quite interesting is if you look at really the far right-hand side of that chart, you can see quite a strong uptick in the relative CDS spreads on a year-to-date basis. And that really talks to the fact that concerns around South African election risk, concerns around fiscal trajectory under different election scenarios is being reflected in South African bonds. Quite interestingly, though, if you look at the chart on the right-hand side, which really shows the South African rand relative to broader EMFX, you can see that the rand's really been trading in line with broader EMFX. You can see kind of around March 2023, between March and June 2023, over the Lady R saga, the rand really pulled away from broader EMFX, but it's now really trading more roughly in line. So the key takeaway there is that the South African bond market is pricing an elevated SA risk, but it's not really being reflected in the currency. So bond market pricing and elevated risk, that's come through in two ways. One is we've got really higher and elevated real yields in South Africa, ranging from about 4.5% to 5%. So that's inflation-linked bonds. You're locking in effectively CPI plus 4.5% to 5%, which is a really high hurdle for other asset classes to compete with in a portfolio horizon that's looking to deliver inflation plus 5.5%. So through that lens, inflation-linked bonds are attractive for us. We are aware that they are reflecting some risk. As you move across into nominal bonds, and this is where a lot of the more recent risk on a year-to-date basis has been reflected, there's a significantly higher inflation risk premium priced into South African nominal bonds than what we've seen over the longer term, effectively at the 10-year point about a 1.8% inflation risk premium. So what that means is kind of on the lower risk side, you have inflation-linked bonds offering between 4.5% to 5% real, but nominal bonds offering up to effectively 7% real returns over the next 5 to 10 years, which obviously comes with a reflection of risk. But for us, that's really attractive in terms of how we think about long-term asset class returns. And those high real rates ultimately also feed into SA equity valuations. The chart on the left here is just looking at broad SA equity valuations. We use the CAPE ratio as our preferred metric here. And purely looking at SA equity in isolation, it is really cheap relative to its long-term history. The only other times it's really been at this level have been during COVID, kind of during the GFC and the early 2000s. So SA equities on a standalone basis are attractive. But when you adjust for the high real rates in South Africa, which is what the chart on the right is doing, you can see that South African equities have actually gone from relatively expensive compared to where real rates are to now just moving to a much more fair value type framework over the next 5 to 10 years. So for us, we've seen that significant derating in SA equities, reflecting some of the risk, has moved SA equities closer to fair value for us. So kind of summing up some of the key takeaways from the risks that are being priced around South African elections, we're seeing much higher real rates together with elevated inflation risk premiums. That is really what's driving the attractive real returns on offer in South African bonds. But this is not really being reflected in the rand. So as we think about building a well-diversified portfolio, we prefer to hold quite a high allocation to South African bonds, but diversify that with quite a high allocation to hard currency exposure in the portfolio, given where the relative risks are being reflected in asset class prices. And equally, over the last month and a half, we've been running as Anton mentioned, we've been running quite a underweight position to South African equities for the last 18 months, which as valuations have adjusted and moved closer to fair value, we've effectively closed as South African equities are reflecting the high real rates now on offer in the country. So that gives you kind of a high level overview of our thinking around the risks associated to South African elections and how that feeds into how we build a portfolio. And we've had kind of this real significant derating in SA equities being the laggard asset class. On the other side of the pond, US equities have really been the standout performer. And Anton you can take us through some of the drivers around that strong performance.
Yeah, brilliant. Thanks, Chris. And please keep your questions coming. I'm sure there's going to be a lot of them on the things that Chris has covered in the last 10 minutes. So yeah, US equities obviously been the fantastic show in town. In fact, if you look at this chart here, this takes US equities back over the last 30 years. And if you've held US equities buy and hold, you've generated 8% per annum real returns in dollars. So if you add on the currency depreciation, it's been a fantastic journey if you've been able to hold US equities in substantial size in the portfolio. So we know the story. I mean, if you actually roll back that clock to the last 30 years, it's when one Alan Greenspan took over the Fed and monetary policy and the world as we know it changed. So, let's just take a look at this, and we're not going to go into anything around stocks. We're not going to talk about artificial intelligence, and I'm going to try and avoid talking about Donald Trump and really focus in on the numbers. And we've been doing a few roadshows around this and kind of some of the issues and some of the numbers underlying that return over the last 30 years. And the deeper you go into this, the more interesting it really is. And we've only got a short time, so I won't spend a huge amount of time on it. But what this chart does, it takes the 8% and it breaks it down into four kind of drivers of the return. Firstly is your dividend. So you can see the dividend is contributed 2.2%. We've had a real EPS impact, which is really through revenue and margin. It's your top line growth and a bit of margin improvement in the US at 2.4%. Interestingly, US top line growth. So this is US corporates, non-financials over the last 30 years. Top line growth has been around 2%. It's actually below US GDP. So if you think about what's happened in the US with the internet boom and globalization and AI and all these fantastic things that we know, in fact, actually US corporates have generated revenue growth of less than GDP. So that's something which definitely the data was super interesting to us. And then we get to the two other parts, and the two other parts represent almost 40% of this 8% or so real return. It's firstly this number 1.4%, and this is the impact in the US of lower interest rates. So we know we've been in a secular decline in interest rates since the 80s, and then secondly in taxes. So taxes have been declining. We'll talk a bit about that when we go into the charts on the next slide. But taxes have really been declining since Ronald Reagan took over in the US. So all Republican presidents, be it Reagan, be it Bush, and then more recently Trump, have decreased taxes, and the Democrats have not increased them. So you've had this structural decline in taxes from around the mid-40s back in the 80s to an effective tax rate now of 15% in the US. So those two things, just interest in taxes every year for the last 30 years, have contributed 1.4% positive impact on earnings growth and therefore total returns. And then the final piece is valuations. Back in the late 80s, the multiple for US equities was around 15. We're using the Cape here, and that multiple is now over 30, about 32. So as that multiple's gone from 15 to 32, it's contributed about 2% per annum return contribution to the equities. And I'm going to talk about why this is important in terms of the outlook. But in summary, if you kind of look at that multiple expansion, the vast majority that's got to do with lower interest rates. You discount your earnings at a lower interest rate, it impacts your multiple. And then the remainder is, I say, tax and interest. So 40% of the 8% return is coming from two very important structural themes, which are lower interest rates and taxes. And as we know, those two themes are largely coming to an end. And we're at some point in that cycle. The left-hand chart shows you the kind of what we've seen over the last 4 decades with falling interest rates. And then you can see really towards the end there, as we all know, we've seen a structural shift here in higher interest rates really for the first time significantly in the last 15 years, but you can see it's really been a trend change there. So we know interest rates are going higher, have gone higher. And as they've gone higher, so corporates have had to refinance at a higher rate. And then secondly, on the right-hand side is this point that I made around taxes. So this is the effective tax rate. And you can see it reached a low of around 15%. We have Trump's tax cuts from 2019 due for renewal, or due for expiry, may I say, next year. So tax rates are definitely, I had to use the word definitely, but it's very unlikely the tax rates are going any lower from here in the US, given where we are. So two big tailwinds become two big structural headwinds in the US, really from here and for the next 10 years. And this is why this is relevant for the next 10 years. So that's very much around US earnings. And then the other factor is around valuations. Chris mentioned the impact of the top seven, the Magnificent Seven. We know a lot about this all now, but it's obviously been a big driver of return. But really importantly, what that's meant, and this is that right-hand chart there, which you can see is that the S&P 500 now is at kind of nosebleed levels from a valuations multiple perspective. And doesn't mean that it can't go higher. Anything's possible in this business. And we, in fact, have seen higher multiples in the late 90s, 2000s. We saw multiples go higher. But we really are at that point whereby we're in the top kind of few percentile of multiples from the US valuations perspective. So we've mentioned two really critically important points for returns over the next 10 years in US equities. Number one is earnings, and we've described like how the kind of tailwinds have become headwinds, and the second is ultimately a repricing of the multiple. And given where we are in the multiple, that obviously was a significant tailwind, which is now a headwind. So the big issue which we have now is clearly around the US equity market, which is very expensive and priced for perfection. But the good news is the rest of the world is looking less extreme. The rest of the world is not cheap, and we will unpack that when we go into our positioning. But relative to US equities, it is not cheap. But importantly, it does actually offer more value. So, in terms of what we're doing about this critical part of the portfolio, Chris, I'm going to hand over to you just to talk through some of the implications for the portfolio.
Yeah. So, I mean, as you quite clearly unpacked there, Anton, there are really two big risks. One is around valuations, and the other is around concentration. So for us, in terms of how we look to build our exposure to asset classes, is that we want broad, diversified exposure to asset classes where there's not one single country, one single share that has an outsized impact on performance. And we also look to do so at more attractive valuations, as they really are quite powerful in terms of determining returns over the next 5 to 10 years. So how we're controlling for these risks in portfolios is we're using a range of different indices to build out our global equity exposure. In the US, we're using an equal-weighted S&P 500 index to control for those concentration risks. And we're pairing that together with developed market ex-US exposure, where valuations are not at those nosebleed levels that you were talking about. So it just talks to how we can use a combination of indices to manage and control for risks that we see in broader global markets. To illustrate what that means relative to those risks that we've highlighted, we've effectively pulled up here a number of different charts that all talk to our global equity exposure. And we compare that to the MSCI All Country World, which is effectively broad global equity market with a combination of DM and EM equity market exposure covering effectively the investable universe. So we can start off on the chart on the top left, and there you can really see that our exposure to the US is lower than what you have in broad market cap indices. And that's effectively talking to the valuation concerns as well as the headwinds to US equity returns that Anton unpacked. Given the concentration of the Magnificent Seven in S&P 500, and given the weight of the S&P 500 in broader global equity markets, diversifying away from that concentrated exposure naturally leads to a reduction in exposure to technology sectors and the communication sectors, which are really where a lot of the concentration sits, and you can see that at a sector exposure as well. And equally, in terms of feeding through to our exposure to the 10 largest shares, and you can see that from a concentration perspective, we've got about half, our top 10 are about half the weight of that of broad market cap indices. And then just as important, Anton was talking about kind of S&P 500 valuations and cap ratios up at around 32 times. Broad all country world index is sitting closer to 27 times, while our basket is sitting closer to about 22 times. So very clearly looking to manage the risks that have been so clearly articulated, and this is ultimately the build-up of our global equity exposure. As we move on from US equities and global equities, as Anton mentioned, the big elephant in the room this year is certainly, and actually the cycle, has certainly been fiscal policy. If you look at the chart on the left, it's effectively showing the US fiscal deficit as a percentage of GDP. And what you can see is that there's actually, from about 2000, there's been a general trend of that fiscal deficit increasing. But if you strip out periods of recession, so the most recent two would have been COVID and the GFC, and war times, the current fiscal deficit is the largest that it's been with the economy in a normal steady state. And ultimately, that's come through both increased spending and a reduction in taxes that Anton had spoke about and linked to the strong performance of US equities going back over the last 40 years. Ultimately, if you are earning less and you're spending more, you need to finance the difference with debt, and that's what's happened. From a pre-GFC level of about 60% debt to GDP, the US debt has effectively doubled, going from that 60% to about 120% of debt to GDP. So the amount of outstanding debt has had to be taken on in order to continue spending more than it's earning. And that happened really at a time when interest rates were relatively low. What you've had this cycle, which has been incredibly interesting, is you've had this very loose fiscal policy coming against tightening monetary policy. And you can see that in terms of what interest rates have done over the last 2.5, 3 years. That sharp uptick in interest rates has really been as a result of the tightening monetary policy. But actually, the fiscal policy that's been loose has almost been dominating monetary policy. And you've seen that through strong economic growth coming through in the US, as well as the fact that inflation is now landing at a slightly stickier and higher level of around 3%. Ultimately, as a lot of the supply side constraints to inflation have worked their way through. So set against this backdrop, Anton, like what are some of the considerations we need to think about as we're allocating to US bonds?
So I think just to continue from what you were saying around deficits and government debt, because this is something which I think all of us have an opinion on. We read a lot about it. We're obviously very familiar with what it is and what it means in South Africa. And I want to just kind of provide a little bit of context on that first before we kind of unpack the answer to your question. So debt per se isn't necessarily a problem if you are funding that debt at 0%. So the obvious example was Japan. Japan has a debt to GDP of 240, 250%, kind of lose count of the side, but that type of ballpark. And they've continued to ratchet that up for the last 3 decades. And all the kind of individuals who were short JGBs, long time retired from this industry.
The Widowmaker.
The Widowmaker, absolutely. So, you know, it's kind of irrelevant when you're funding your debt to zero. And that's what's really happened in Japan for a long time. And actually in Europe and in the US more recently, it has been largely irrelevant because the cost of that debt has been very cheap. You flip it to the other side, which is South Africa. South Africa, our debt to GDP is 75%. That's compared to 120% in the US. But it's a major issue here because we're funding that debt at 11, 12%, depending on where we are. So it's the cost of the funding of the debt which is so important. Otherwise, you can continue to play this game of running massive deficits, running up your debts. They're really into infinity if it's sitting at 0, 1% worth of funding. And this chart here that you have in front of you kind of shows really this combining of the 2 points that Chris has made, which is Firstly, this massive increase in debt, particularly post-COVID, and deficits that were being run. We're running a significant deficit in actually a very strong economy. And combining that with the increase in interest rates, you're kind of reaching that point now where you see on the right-hand side where the cost of the funding of that debt is now going up, as you would expect. We're writing the funding, and that interest cost is going up in the US. So that's the first point, which makes it now more relevant than it has been really over the last decade for developed markets. For the first time, we really have higher funding costs, and we're rolling that funding into higher levels of debt. On the left-hand side, the way that this has been kind of largely done has been through a lot of short-dated issuance. So you can see the kind of shape of that issuance being very much at the short end over the last 12 months. And this combines with the second element of why 2024 becomes relevant for this elephant in the room. So firstly, it's that chart you see there on the right-hand side. And then secondly is liquidity. Now, Chris and I spend probably too much time on spreadsheets and a bit nerdy looking through liquidity and all the different drivers of liquidity. But the reality is liquidity is in many ways more important than interest rates. Liquidity going into the market and out of the market ultimately has a huge impact on portfolio performance. I'm not going to unpack all of these lines here in front of you. I just want to draw out the dark blue one. The dark blue one is just the net liquidity over the last 4 years since the kind of the extreme policies of COVID, and then it kind of tracks it over the last few years. I just want to raise 2 points here. Firstly, you can see in that the left-hand arrow that we have there that there was a decline in liquidity. This is effectively Fed injected liquidity into the system. The decline in liquidity in 2022 of I think the number is somewhere $1.7 trillion over that period. And we all know what happened in 2022 with bonds and equities. And interestingly, despite the fact that we've had higher interest rates, the Fed kept on hiking rates. Actually, what we saw from the mini banking crisis we had in the US first quarter last year is an injection of liquidity. So we've actually had around $700 billion worth of new liquidity injected into the system. And the reason why that's important for treasuries is effectively that net liquidity has been taking down the supply that we've been having, and we've had no issue in the treasury market. And the ability for the government to fund at a shorter rate has helped with that. But like with all good things, that everything does come to an end, and liquidity is a cyclical thing. The Fed can ultimately change the direction of this, but holding all else constant, that liquidity, the net liquidity impact, kind of comes to an end towards the end of the third quarter. So, in conclusion, around this theme, because we could spend hours, days on this, and it's a super important theme for us all to concentrate on here, is the Fed has to fund a massive fiscal deficit and a massive amount of debt between now and year end. Number one. Number two is the liquidity that was available to fund that issuance is the net liquidity is coming to an end at some point in Q3. And then thirdly, which is the most difficult one to predict, is we have an election, a critical election towards the end of this year, and fiscal spending is going to be a hugely debated topic. So, who knows? Trying to understand exactly how markets are going to play out is difficult. But, our view from a risk perspective, when we look at bond markets and we look at the impact this has on the portfolio, is that we are definitely got our eye out for the risks inherent in the fiscal position in the US. So let's just finish off now, Chris, in terms of what this means for the portfolio. Finish off the section.
No, certainly. I mean, ultimately, as Anton alluded to, and we saw this in 2022, this positive stock bond correlation in the US, which is kind of for the first time in more than 20 years, stocks and bonds selling off at the same time. So set against all the challenges that Anton's articulated, potentially the diversification benefit from stocks and bonds is potentially somewhat muted, and the role that cash plays in the portfolio from an asset class diversification perspective is important for us. And it's doing so at a time when you've got really high real yields on cash. So actually, ultimately, that holding cash is an option to buy asset classes at cheaper valuations, whether that's bonds or equities. And typically options have a cost, but at the current moment, holding cash has a very low cost because of the high real returns that that's currently delivering. So for us, both from a portfolio diversification perspective, as well from kind of a real rate perspective, cash is ultimately attractive, and so that really kind of summarizes, I think, the key risks around US fiscal risk. I'm going to finish off quickly. We've spoken about a lot of shorter term risks that we see over the rest of 2024, but ultimately our process and the way that we build portfolios is fundamentally anchored by long-term return expectations over the next 5 to 10 years. And from that, we can see really that there are two standouts. First, South African bonds are set to deliver returns materially higher than what they have over the long term, ranging from kind of real 5 from linkers up to close to real 7 from nominal bonds. And that compares to kind of 1.5 to 2% real over the long term. So we know South African bonds are attractive. It does come with risks that we're aware of, but that filters into how we build hard currency exposure in the portfolio. And on the other hand, you have US equities, which are at this level really expensive, together with challenges around the headwinds of higher interest rates and taxes over the coming years, set return expectations for US equities actually negative over the next 10 years for us. So those are the two standouts, the asset classes that are cheap and that are expensive. Across the rest of the asset classes, so from global bonds to emerging market equities, developed market equities, they're slightly expensive, but roughly in the region of fair value, and SA equity also fair value. We're kind of at weight for those asset classes, and you can see both global cash and South African cash are currently yielding high and attractive real rates. So that kind of summarizes our portfolio positioning in terms of our views and ultimately how we built the portfolio. More conservatively positioned, a higher allocation ultimately to cash asset classes, both locally and offshore, a higher allocation to South African bonds, and a lower allocation to developed market equities and primarily through the US. So we managed to get through that. It was maybe slightly longer than 40 minutes, but if there are some questions, we're definitely I really appreciate the opportunity to answer those. And thanks very much for joining to hear our view in terms of the next couple of months and how the portfolio is positioned to ultimately deliver the client objective over the next 5 to 10 years.
Thanks very much, Chris and Anton. We promised an opportunity to ask questions and have a bit of a discussion. So please put your questions in the Q&A tool now. Yeah, I must say, I've obviously heard Chris and Anton speak about these themes before, but I think it is always astounding to kind of focus on the importance of liquidity, especially in the US market. And that chart about how 40% of what's been driving in the US is just low interest rates and low taxes is always quite astounding. So some questions are starting to come through. First one, could you talk a little bit more about CAPE? You referenced this metric several times.
Sure. So it's the cyclically adjusted PE ratio. Effectively, what it does is it takes the last 10 years of earnings, because earnings in any one year can be quite lumpy, and that can drive short-term valuation metrics. But the idea around taking the last 10 years of earnings is to ultimately smooth out the trajectory to get a longer-term view of where earnings are, and that's adjusted for inflation and ultimately compared to current prices. So it gives you a sense over the longer term, which is tied, most importantly, back over the time horizon that we're managing this portfolio, to give you that longer-term idea of valuations across markets.
I think the reason why we find it more useful is firstly that long-term point that Chris made. But using the other two metrics, so firstly is your forward PE, is typically your forward PE, which is taking the next 12 months earnings and applying that to the current price, is embedded with a lot of analysts' optimistic expectations. It's quite fascinating to look. I mean, what are the current earnings expectations? 30% in the US. Yeah. And then the flip side is if you use current earnings and you're going through the opposite, you're going through let's say a recession and earnings have really tanked, then in a sense your PE is kind of moving in the other way, sending you a false signal. So using a kind of a forecast, we're not in the forecast business in terms of that, so that doesn't help us. And then a current Cape kind of delves with what are the numbers and how do we smooth that out. So that's why we find it much more. And actually, its predictive value on a long-term basis is also very, once again, long-term, short-term, absolutely not, but long-term, very, very reliable.
And I think that's key, is that they are really strong predictors over the 5-year time horizon. They don't tell you anything about what asset classes are going to do over the next kind of 6 months or the next year.
Yeah, it's true.
Thank you. A question from Charlotte. Has the recent bounce in commodity prices and shift in the Fed's rhetoric influenced your views on the US rate cycle? Do you think that the Fed will be forced to revise the inflation target due to a structural shift in inflation dynamics post-COVID?
That's a great question. Yeah, I'll have a stab. I mean, I think it's a super relevant question. Particularly, we got the CPI printout for March yesterday, and I think on the back of a few higher prints before that, is definitely now a kind of a relatively firmly entrenched trajectory here that inflation has kind of bottomed, and in fact, in some ways, actually picking up. And if you go back to what the Fed said in December, when everyone got super excited about rate cuts, was that inflation would go down to 2%, and therefore they were going to cut, what was the number, 75 basis points in their outlook, and the market was up at 6 rate cuts at the end of last year. So, yeah, I think there's a real question mark that was, as we're seeing in terms of market reaction today. And that's very connected to the point around commodities. A large part of that inflation uptick is around energy. So, kind of gasoline prices in the US and all of that have ticked up. And we're seeing, higher commodity prices in other areas like copper and iron ore. So, yeah, it does feel that this kind of nice, comfortable narrative around rate cuts in the US, once again, supporting markets, etc., is starting to dissipate. And that it's very unlikely at this stage, what we know now, that the Fed will be cutting rates in June. So, we don't forecast rate cuts. We're not forecasting a view here from our perspective. We're just observing market pricing and observing what's actually happening. And at this stage, given the strength of the US economy, given commodities, given inflation, it's very unlikely the Fed will be cutting anytime soon.
And I think the other interesting thing as well, even under the Fed's framework and where they were saying that they see kind of 3 interest rate cuts this year, they only saw inflation actually getting back to 2% somewhere out in 25, 26. So it does talk to the point that you make there in terms of their level of being comfortable with inflation taking much longer to get back to that target of longer term, which certainly does open the gap, I think, in terms of strong economic growth still coming.
Yeah.
That was a good question. Thank you. And a good answer too.
Oh.
An anonymous question here. What is your view on private equity, both global and local?
I must say, we don't invest in private equity in our funds. So, I don't have a very firmly held view on private equity in terms of performance. I would say that the major issue around private equity is funding costs. And we know that in terms of what's happened in the last 2 years. So to take a bullish view on private equity, you have to have a view on what will happen to funding costs over the next 12 months. But in terms of the asset class, I'm not going to respond because I won't give you much insight.
Okay, some questions coming through about whether the slides and recordings will be available. Yes, we'll circulate the slides and the recording will be available, so you can share it with your colleagues if they missed it and you think they'd be interested. Another question here. Indian equities, guys, bullish or bearish?
So I think our approach in terms of building or seeking to build well-diversified exposure to asset classes really sort of is the core anchor in terms of how we look at different asset markets. So we're not really in the game of kind of taking a punt on very specific sectors or very specific countries. I mean, some observations that we can make. I mean, there certainly is a strong fundamental growth story around the Indian economy. And actually, to be honest, I think the South African economy could take a few lessons out of what's happened in India over the last 5 to 10 years in terms of the transformation that's going there. But that is coupled with really excessive valuations at this point. It's quite interesting if you kind of stand back and just look at broader emerging markets. In 2020, China made up about 40% of broader emerging markets, and we've seen the Chinese market derate quite materially over the last 2-3 years, to the point where it's making up between kind of 25 and 30%. And that's kind of been couched with the rise of Indian equities, which kind of effectively make up about 25% of emerging market equities at this point in time. And everyone thinks emerging markets might be this really cheap asset class because of what's happening with Chinese equities, but that's really been offset and some by the run-up in Indian equities. So if we had to take that into our framework, ultimately building portfolios for the next 5 to 10 years, certainly the valuations are a challenge in terms of Indian equities. It doesn't say that they can't continue to run up over the next 1, 2, even 3 years, but valuations are a headwind ultimately. And many of those positive changes in the economy are being discounted. Not sure if you have anything else to add.
And while we're in that direction, we're going to head even a bit further east with a question about Japan. Do we have a view there? What's our approach?
Yeah, I think just it's going to be very much similar to what Chris has said. If you actually look at the chart here, apologies, I'm going to jump around a little bit, but if you look at the Japan exposure, it's pretty neutral. I mean, there are lots of obviously stories around what's happened with Japan. A lot of it had to do with the currency. Multiples, the valuations have most certainly got a lot more expensive, but you can see here, we don't have an explicit view on whether Japan is an overweight or underweight in the portfolio. Valuations are looking a bit rich, but we don't have a short-term view on Japan. So we're pretty neutral.
Maybe it's also worthwhile just kind of explaining why we do strip out the US and look at that in isolation. The fact is, it makes up 65% of global market cap. So ultimately, what happens to the US is really, if you're holding kind of a market cap weighted index, is going to deliver the outcome of that broader index. So it really warrants a lot closer attention in terms of our framework, just given the concentration that one has in.
Okay, thank you. And I'm going to take one last question. So that we can end on time, and anyone who's got to dial off, we really appreciate you taking a moment to do the survey when you leave us. Okay, 2 last questions. Any views on USD ZAR short-term and or long-term outlook?
I mean, predicting the currency is a mug's game, right? Over the short term and long term. I mean, look, if you look at it from like a valuation basis, whether that's PPP or whether that's real effective exchange rates, the currency is cheap. But equally, one can make the argument that it's cheap for a reason as well, given a lot of the concerns that we're seeing. Rather than trying to forecast the direction of the rand, as we articulated in terms of unpacking the risks around the SA election, is try to understand what risk is priced into different asset classes. So for us, we see that there's certainly value that's being priced into South African bonds, but considering the overall risk in the portfolio and the diversification in the portfolio, and that the fact that some of those risks might not be priced into the rand, we kind of build the portfolio with hard currency exposure whilst benefiting from sort of attractive valuations in the bond. And we really think about the currency much more through a risk control and a risk lever in portfolios to diversify not only South African growth asset exposure, but overall growth asset exposure. Because as you saw in periods of global growth shocks like the GFC or COVID, the rand was a great diversifier. Equally for SA-specific risks like Lady R last year, again, the rand was a great diversifying tool. So we think about it much more through that lens of risk management than taking any view in terms of where the rand will be.
Thank you. Okay, so this really is the last question, and I think it leads on quite nice because you spoke there about short-term and long-term. So this question is around the fact that our three themes are quite focused on short-term events like SA elections, but both Chris and Anton especially spoke about looking at 10-year views. So how do you balance this focusing on short-term events but focusing on the long-term outcomes for investors?
I'll take that. Jump in. So I think the starting point is evaluations-based approach on long term. So our models and all of the portfolio decisions are made around kind of the relative value and attractiveness of asset classes, looking out over the 5 to 10 year basis on a real return. And that's really the main driver of any portfolio changes that we make. We made very limited portfolio changes over a course of 12 months, because in reality, those things don't change substantially. But if over a period of a quarter or 6 months, you see a significant change in prices, then that changes the long-term opportunity in that asset class. So I think that's the first thing to make, is that it's very long-term driven, and prices, as they do move, will change the long-term opportunity you have in owning an asset class. The kind of bit which comes at the end of that is a risk overlay, right? So we just talked about diversification. Diversification is a very important tool to manage risk. But the other one is ultimately, what are the risk factors which we want to concentrate on, which could impact the portfolio return, and what could actually change some of the longer term type of valuations approaches that we look at. So, for example, we talked a lot today around US Treasury bonds. US Treasury yields at 2.5%, real yields of 2.5% are very attractive. But if we have a significant fiscal issue, then it could go quite a lot higher. So we want to factor in what are the short term, what are the major themes over the next 12 months, which can lead to kind of downside risk in the portfolio. So it is almost a risk overlay that we look at the kind of the shorter term things, Michelle. But the process is obviously very focused on building it for the long term.
No, I think that encapsulates perfectly.
Great. No, thank you very much. And please don't hesitate to send any more questions over email to us. We're always available. And I hope you will join us next at the end of Q2 when we do this again. And thanks again for your time today. And thank you, Chris and Anton, for sharing your views.
Thank you very much for joining.
Thank you.
Cheers.